Wake up, buyer payer people. It's a beautiful day. Go grab yourself another cup of joe and say hello to Jim and Michelle Rhoads on the Buy Here Pay Here Morning Show. Take it away, you two.
Good morning.
Michelle's being her usual silly self.
Well, you know, I know the opening intro and the dialogue and all of that by heart, even like the cadence. And so I'm over here just mouthing it all and singing along with them. And I mean, it's just because it's fun.
And I'm over here trying to get spreadsheets ready, and she's just being goofy.
I'm just being goofy.
Usually it's the other way around, or it's often the other way around.
Happy Friday, everybody.
Welcome.
Glad to have you here.
Yeah.
And
beautiful morning in the backyard in Oklahoma. We are still here dealing with some family matters, and looking forward to get back to Utah. And you know, we got a lot of clothes back in Utah that I'm missing.
Oh my goodness! I had a neighbor here that said, "So you just have your wardrobe that you brought with you?" And it's like, yeah, I was only planning on staying here for a week. So
we actually, when we originally came in early July, we were coming because my mother was not well, and so we just came long enough to, you know, see her through a situation with her health, and so it turned into something different. But anyway, we're happy to be here. The weather's beautiful today, and happy to have you here for a Friday. Got some really important stuff to talk about.
Yeah, we really don't have any announcements, so
no, I do have one update. We had a V8 Plus session yesterday around trade. So it was around internal trades, and this was a subject that, as we often do with those V8 Plus sessions, we ask our members if there are any subjects, and that came up in one of our meetings. And it was I noticed it was a thread in the BHPH Success group, because I was tagged by one of the dealers that was in that session yesterday. Said, hey, look, here's the same conversation we just had basically in our V8 Plus session. And it was really interesting. We had some dealers there that are former bankers, and so they were able to kind of add the financial perspectives to the whole conversation. And it's not too different than the conversation we're gonna have today. I mean, yesterday's was around when we trade a car at the we picked the 24-month mark. I work a lot with 24 months in V8, and we looked at the 24-month mark. So what does it look like for the dealership when we do an internal trade a customer that's about 24 months into their contract? In that example, what does it look like for their profit? What does it look like for their balance sheet, you know, their assets and their cash flow? Really
great, powerful conversation.
It was meaningful.
Because, you know, we teach that an awful lot, like you said. And because what that does when you trade someone in after 24 months, you know, a lot of dealers are going to like, that's a lot of work. That means I'm going to have to reach out. I'm going to have to start communication. And yes, there is more work involved. There are a lot of options nowadays for how to reach out that don't require you to hire more people. But the idea that you can have them stay with a car for 2 years and they're happy with it, and then put them in a new car that they're going to be happy with for another 2 years, and then maybe put them in a new car that they're going to be happy with for 2 years, and that you keep trading them out into something that's newer. Because I mean, all of us are consumers, and all of us here likely have a different car in 5 years or less. That's just what happens.
I think, you know, that's what customers have an interest in doing. And sometimes the math doesn't work, right? And every dealer's got a different strategy and policy around this. But what we try to do is say, maybe we can put more information in front of you so that you can craft your policy, you know, according to that. And so hopefully we provide enough information to help dealers kind of shape, you know, how they want to do that.
So let's just the conversation is about, you know, the way you put it is
today's conversation is
repos.
About repos. Yeah. So shifting into our subject for today is like, we're looking at repos. We've been watching, and we know that repo rates are up. We heard in particular, Steve Karstens from Shilson Goldberg and Chung came out with their report some months ago that said 2024 was the worst charge-off month or charge-off period that they've seen. And I need to refer back to that so I know exactly what they were calculating. But you know, generally speaking, they said charge-offs were the worst they've seen since they've been tracking it, since they've been doing that kind of annual report. And then we've seen charge-off rates continue to run high in 2025. So you got to be careful when you talk about these kind of things, because there's all these different ways to measure. There's charge-offs in severity, which is going to be the number the dollars of accounts. There's going to be charge-offs in frequency, which is the number. And so you just really need to be specific. We all need to challenge ourselves to be as specific as possible when we talk about numbers of this nature.
Mm-hmm.
And so for today, I've got a small pool, but the way I'm thinking about this is I went through our V8 members that have data back to January of 2024. So there's a fair number of those. I extracted from those dealers who had kind of irregular things in their operation. They may have acquired contracts or sold contracts, which would affect, a lot of the numbers. So I pulled those dealers out, but I ended up with enough dealers to be able to illustrate kind of what we're seeing. And the part I really wanted to examine is when charge-offs are up. In theory, if we're recovering repos and those repos still have value, then in theory, our cash could increase during that period of time.
Mm-hmm.
We know that there are dealers out there who have a practice of, repossessing on a pretty short cycle because it actually, boosts their cash. And while that's a whole different subject
Mm-hmm.
for a different day, today we're just looking at when we experience higher charge-offs, how is the fact that we're experiencing recovery showing up in our bank account? And so we can look at some numbers here. We can go into the details. Let me just show you before we look at numbers. Everything you're going to see here today is based on a 6-month rolling average. So when you see June of 2024, that means the 6-month period ending June 2024. Okay, and we're working with averages here. So this is, not insignificant. It's something to think about. And I chose to look at a couple different metrics. You want to go ahead and share that, Michelle? And
Absolutely.
We'll
and good morning, Stephen. Thank you for the comment.
Yeah, Stephen, thanks for being here.
Yeah.
And so if you can see the numbers well enough, I'll do what I can to expand it on my side or increase the zoom in a little bit. Yeah, that looks better on the viewer side. But what I chose to look at was first interest coverage. So let me remind those who haven't heard the podcast very often. We talk about this number from time to time, but interest coverage is a number that a lot of lenders would pay attention to, and we would say that most of us who have a finance company or even in the buy here, pay here, lease here, pay here business ought to watch this number. It is the amount of interest that we collect in a certain range relative to the net charge-offs that we experience in that range. Mm-hmm. So if you think about, just generally speaking, the reason buy here, pay here, lease here, pay here dealers charge a higher effective interest rate is because they have a higher risk portfolio. They anticipate higher losses. And so that's why we charge the higher interest rate. So this number is really just looking at, is our interest covering our losses. Mm-hmm. Okay, so this doesn't have anything to do with
because that expenses. Is again, I mean, what you're looking at this from the outside as someone that's not, if the reason we have high interest rates are to cover our losses, then this is a really good reason to show why we have higher interest rates. And yes.
So let's look at them one at a time here. So I charted the same information, and I'm just going to click one at a time, and we can talk about, again, it doesn't matter where these dealers are. What we're really looking at is their history. And even though this particular graph only brings in 5 dealers, that's still, if you're a single dealer in Middleville, Tennessee, you don't have much to compare to. So I'm offering you a look at 5 other dealers across an 18-month period, looking at 6-month rolling average. So this is a trend across these dealers across this period of time. And I think as importantly is that it's less important what these dealers show is what your own numbers show, and kind of how to calculate it, what methods we're using to arrive at this information. So the interest coverage, again, it shows this dealer here, you can see that they've had more volatility in theirs. Because again, when you're looking at a 6-month rolling average, you would expect these lines to be smoother. All of these are 6-month rolling average. So this dealer's had a little more volatility.
They don't go below ever. Yeah. But it is a lot more sporadic.
So I'm glad you mentioned the below, because I hadn't explained that, ideally we want that number to cover. We want our interest to cover the net charge-offs. And if we were above that mark, then you're right. We would be above that 0 line there, and we would be in a positive range. So this dealer is positive, but they're a little more sporadic. Now this dealer, you can see their numbers are
I've just
down.
been trending down.
They're trending down, although we've seen an uptick in the last, since April. The, again, 3-month average or 6-month average is trending up now, May and June. So hopefully that's an indication, at least for that dealer, that there's some positive, movement. This dealer is showing
pretty level.
They had, they actually have been up in 2025 versus 2024. I think you can see that they're better than they have been. So yet another indication that some of these things may be improving. And one of the things that happened last evening, we had some people that we know that reached out to us about possibly investing in the subprime auto space. And so we were able to talk about some of the trends and some of the things that are happening. I think this is another indication kind of what is happening in this world of buy here, pay here. This one is,
and also pretty level. It looks like they've dropped below, or just been no, they've dropped a little bit. They've dropped below, but they've
dropped below. But you can see in 2025, I would say their numbers are higher. They're trending higher in 2025 than where they were last year. And then here's another dealer that is also showing to be down. You can see that's a pretty sharp drop off in terms of their charge off rates. But again, we're only really looking at 2024. I wish, and keep in mind, our V8 data only really started in January of 2024. So we don't have, it would be nice to be able to see this same information dating back to the period prior, because 2024 is the period that charge off started to happen. But at least relative to the long-term range. But that's part of what we're trying to study here. Do you have questions?
Well, I do, and I'm not sure if it's something that you're planning on going into, but like, what are the interest rates?
Oh yeah, I don't have that of each of these dealers. I didn't chart it here or have a reference, but most of them are in the low 20s.
Okay.
I don't know that we've got
20,
anybody.
21, 22.
Yeah, just thinking through the list there, I don't know that we've got anybody in the 28% range.
I do know, I don't know if this is reflective of, you've got some dealers that are like in 17, 18% interest rates.
I don't know that any of those are represented here, but that's, that will be a factor. I mean, everybody's got their different strategies and their business models and how they choose different ACVs, cost of car. I mean, there's a lot of different factors here. But I think the things that we're trying to look at, and so let me look at, let me show you again. So a couple of numbers that we have here is total portfolio cash yield. But obviously when you have portfolio ranges for these dealers can be vary in size. So what they actually yield, let's look at this dealer. Back in June of 2024, their yield of their entire portfolio is 167. Now they're up to 249. So obviously some growth. Same for this dealer, 67 up to 148. Here's a dealer that's quite large. They were bringing in 1.5 total. This is, when I say yield, I mean all monies generated by the portfolio, not looking at down payments, just looking at money brought in by the portfolio. So principal collected, interest collected.
This
and then
is
repos.
After they've left the dealership kind of thing. Is that what you're talking about?
No, this is all contracts in the portfolio. How much cash do we bring in on a monthly basis, or in this case, a 6-month average basis, for all types of money that's generated by the portfolio, which is not down payment. What's generated by the portfolio will be principal and interest, and then repo recoveries. I treat those as cash. So this is why, for purpose of our study, the part I really want to look at, and I've got a graph of it, so it'll make a lot more sense, but look at these numbers where we look at repo recovery as a percentage of the total amount of money brought in by the portfolio. So again, that total yield. And I just said, okay, what percentage of the money that we're bringing into the operation is coming from repos? Follow? So let's look at this first dealer. Back in June of 2024, they were bringing in about 12% of their total money coming into the business was coming from repos. And that's going to be a cash value, right? Dealers are using a wholesale cash value. This is another area that's problematic in our industry, that where we just don't have consistency. These dealers have consistency. The ones that I charted have consistency in the way that they handle their repos. But this dealer's up to 19%, right? 19% of the money that they bring into the business on a monthly basis, based on the last 6 months of average, coming from repos. So that shows you that they're up quite a bit. Let's pick another couple more. This dealer is flat, 10.1 and 10.1. Some of these are pretty stable. Here's one that's better. They were at 17% back at the beginning, and now they're down to about 9.1%. So we hope that's an indication. This one, 19%, still 19.6. Here's one that was started out at 7.1, up to 11.9. So we can see this in a chart. Again, I've got it graphed, and I'm kind of taking out the dealers that are anomalous or have kind of unusual numbers. But you can see that recovery as a percentage, again, I just felt like this was the most valid number we could choose because it's a better indication of how much is the repo recovery affecting the bank account.
Okay.
Like how much of it's hitting, it doesn't hit the bank deposit in the same way. So I should probably explain that. My method here is to treat a repo as though it's cash. So if a dealer books in a repo and says its value of wholesale is $5,000, in this calculation, we treat that as cash. Why? Because the dealer is either going to liquidate that at the auction, we hope it brings $5,000, or they're going to put it back in their repo process or their inventory process, which is money they don't have to spend buying a $5,000 car. So it's got a cash impact to the business. So sometimes gets lost in there. It's part of why I wanted to take time to study this, is because it gets lost in there, especially if a dealer's run a line of credit and they've got this money's getting swept into a sweep account and now it's getting adjusted and they get this waterfall settlement at the end of the week or whatever. It just, the money moves so much that it's harder for dealers to be able to get to some of this information and get a good sense of what's really happening in their business. They can feel the charge-offs, obviously, but what we really want to look at here is, this dealer is obviously their recovery as a percentage is up. This dealer recovery as a percentage clearly up, right? They're definitely showing more, of the money that they're bringing in is in repos, not principal and interest. All right. And so this dealer is slightly up, pretty flat. This dealer is up in terms of what percentage of their money is coming from repos. And this dealer is definitely flat. It's probably an indication of their methodology.
Is this just a curious?
You want to take that down?
Oh yeah, absolutely. When we're looking at these numbers, what I'm seeing is that there's the potentiality of a lot of different factors at play.
Right.
One is how good are they at collecting a repo?
Yeah.
Are they getting the car back?
Good point.
The next is, what condition those cars are coming back in. And then things like what we had talked about before, what is the actual interest rate? And there's an awful lot to unpack on that one, because just because you have a higher interest rate doesn't necessarily mean that you're going to do better on this.
Right.
Because you can have a lower interest rate and you're collecting more in a shorter amount of time. So when the repo does happen, you have less that you need to cover the span. So I'm curious, is that something that you've looked at about, is what are their success in repos? Is it that they're having a higher success in actually retaining the cars back? Is it a combination? I mean, there are more repos. We've talked about that. They're across the board, across the industry. There are more repos happening. And so that success of actually being able to recover a car, how much does that affect this?
I haven't studied. We don't have good information that breaks down what percentage of the times that they have a skip account where there is no repo recovery at all versus an actual car recovery. So all we're really looking at is the recovery amounts as reported by the dealer, right? And we validate that information from the software. We verify that these numbers are tied to the software. But I think if I understand your question, I don't have it here in terms of that we do measure recovery as a percentage of gross charge-off. So we would be able to go back and look at that. I didn't bring it for today and I haven't studied it.
Yeah, I think that would be an interesting thing to look at.
Yeah. We can look at that and try to bring the results back in the future. But I think that'll come up as we bring this conversation into our August V8 groups. This is something that we will be we're talking about this analysis and see what dealers conclude from this. But I think, when you look at, if I go back to interest coverage for just a minute, you want to show that, I think the thing that I would urge dealers to think about, and this is again small sample, but just look at the line right there where the zero is. See that zero mark right there?
Mm-hmm.
And just look at what percentage of the dealers are above that line. I mean, you've got a few dealers that are dipping below that line recently, but most are still above that line. So I would say we get kind of nervous when the repos start to happen. We certainly subscribe to the thing that you've heard us talk about in the past that Ken Shilson said. Others have echoed his remarks about we really should periodically go back and examine our charge-offs and look at our projections and say, if our charge-offs doubled, where would that put us from both? So in our case, we want to look at where does that put us from a profitability standpoint? Because that's a question with a lot of lenders now. Let's look at the impact on our cash flow and just totally operationally. Where does it put us? Does it sink us or not? And so when you look at this would say you could go by social media and say, charge-offs are up, they're horrendous. If you just listen to some of the social media threads, am I going to be able to stay in business, blah, blah, blah. Well, this suggests that at least most of these dealers that are at least the members of our V8 groups, most of these dealers are still running in the positive on their interest coverage. So their repo losses are not so severe that, they're running underwater in interest coverage. So put that aside for a minute with most of these dealers and say, well, I don't have a lot, even with my lender and covenants, I don't have a lot to be concerned about over there. So now you look at the cash flow and are my bank accounts improving because I've got more repos. Now I'm not having to spend as much buying cars. And look at the situation operationally speaking. We never want repos. That's not the outcome we're looking for, I hope, as a dealer. And so we hope to be able to recover or save the account, keep the customer paying, and not end up with a charge-off. However, when we do have a charge-off, we need to go the next step and study that and say, what has been the impact to us operationally from a pure bank account standpoint and from an inventory management standpoint? What are the things that are kind of driving us operationally right now? And let's just look at that. It's my nature anyway, but I think sometimes we get a little bit too reactive.
Yeah.
Right. Yeah. And so we look at these. So I think we need a broader study, and we need to make sure that we look at the total thing in a more comprehensive way so that we can make a better judgment about how it's really affecting us. And is it as adverse as we might think? It feels painful, and it is painful in the moment to experience that repo and charge off. I think the bigger question for me today, and we don't have the answer. I think we all need to work together to find these answers about why are the charge offs high. You watch the news and read the paper, and it says, I guess, are there still newspapers? Anyway,
read an article online.
I hear that people read the newspapers, but basically, when you read the news and see the news, it suggests that the economy's great. People are working. Everything indicates
unemployment is down. All of those kind of things.
So we did.
It's interesting. Some articles are talking about people are going more and more into debt.
Right.
And so I'm, not sure how that plays into it, but I mean, for the most part, unemployment is down.
Yeah. And means people have jobs.
So people have jobs.
And so why are our charge-offs up?
Well, and consumer confidence is down, I think.
According to the study
that we were looking at recently.
We had ChatGPT sweep all the stuff because it can do research way faster than we can. And we did a podcast a few weeks ago around that subject, and it basically suggested consumer confidence is down, consumer spending is down. So it kind of depends
and that's across the board. All economic levels is they're not spending, and they're seeing that in a lot of different industries, not just the car industry.
And even though, our small data pool here suggests that things are pretty flat to maybe even improving with the percentage of the dealers that we calculated here. And by the time we get all of our data pulled together for the month of July, then we'll be able to come back with more follow-up information. But basically, I just say we want to make sure that we're prepared for, and we can do projections that tell us, what does it look like if there's no end, if we have another 6 months, a year of this, what does that look like for us, and when can we be prepared for it? Let's be proactive about that and take some measures, take some steps now to make sure that we can manage our way through a scenario like that.
Well, and I'd heard that from Darla about the double, and so she obviously got that from Ken. that is a long game. That's a long game approach to when you're stopping on a regular basis every month or whatever, because we fluctuate, and you're running that and you're looking at that. That's what someone that has a long game approach does with their businesses. They're looking, all right, if this happened, what would happen?
Yeah.
We see frequently dealers that are in the game to just make a bank, speed themselves right off a cliff. I mean, it's just like boom, 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 boom. How do we make as much money as we possibly can? And it's just, there's like buy, sell, buy, sell, without these kind of buffer or things that bring you back down to earth conversations, because that's the long game. That's how you look at the long game, is you're doing things like this on a regular basis. You're looking at, can my portfolio handle a downtick of this kind, and that dealers that have been around for a long time and that have a long game, they don't change their business plan because things look rosy as much as if you're not looking long term. It's like, business plan is working. We continue to work this way and make little minor tweaks, but it's this industry we've seen, and I hear from experience you had as a dealer and talking with dealers across the board, that this ebb and flow, whether it be from capital or repos or the consumer confidence or whatever, it ebbs and flows. It's gone up and down and those dealers that have been around for a long time know that, and they are probably planning differently or looking at how their business model.
Guess what? There will still be ebbs and flows in the future.
There will be
yeah. Ups and downs. So I think one of the takeaways for me here is that if I'm your lender, Michelle, and you're the dealer, and you come to me and you say, like, we're going to have our quarterly sit down or virtual meeting, or however frequently that happens, but you come to me with a plan, and you have what we used to call, I'm no data scientist, but I used to hear them refer to what you call a 2-vector sort of graph that says best case, worst case scenario. And so if you can lead the conversation and show me that you have a plan and we're prepared for these eventualities, and we're managing our way to this, and we're prepared for this, because that to me says that you're on top of your business, kind of where it could go, and that you're prepared to manage your way through those scenarios. If I'm a lender, that's what I think. And when times are tough, I think that's what separates, from just being proactive and maybe even starting the conversation. Like, I would love it if you were the dealer and you reached out to me and said, hey, can we schedule a meeting? We've had our management team meeting and we built the forecast, and I would like to be able to share that with you. I think those conversations don't happen enough. And so this is what I would be urging dealers to do. And obviously, when we think about how do we solve this, how do we reduce the repos and charge off, item one for us is always going to be engage. Make sure we're in communication with our customers and we know what's 100%. Going on with them before they find themselves in that situation. And so that we can be better prepared. And I always say, I said it to somebody yesterday, I did an interview for a guy who's doing a PhD study. And it was really nice to spend some time with him and share a little bit about our industry. And one of the things we talked about is this idea that dealers in our business are, it's a challenging business. It can be a really difficult business. And one of the things that we have, one of the problems that we have in our business is that ours has complexities that others don't have. We have, just like what we're illustrating here today, the timing of profits and cash flow don't always coincide. And we have to make sure we're with a business partner, with an investor, with a lender who understands that piece of our business and can kind of roll through those things with us, but also just has the ability to recognize that these things that happen, we have to be able to manage our way through it, and we can't be too reactive, and we just need to make sure that we're positioned.
And that's another question I didn't even think about bringing in is like their percentage of repos, because that whole connecting to your consumer, because the end game is not really can you cover, but is how many accounts are you saving?
Right.
How many accounts are you continuing to keep on the books? And that actually flows in that other, what you said you had the V8 Plus meeting of, if you did a 24-month trade-in program, that takes that customer off of this repo,
unless it's a life situation thing. I mean,
Yeah.
if it's mechanical, you're probably going to solve some of that. But I think the reality here is we're not going to know, if there's something we can do to save the charge off, that's going to be communication. That's going to be dialogue. That's going to be keeping in touch with our customer and having our customer feel comfortable that they can talk to us about whatever the situation is. So it's true of communication between the dealer and the consumer. It's true of communication between the dealer and the lender. And so I think it's one thing if we're as a dealer playing a long game, but our lender's not, that becomes problematic, right? And so this is why we kind of have to make sure that we're with investors and partners who are, also playing a long game with us in the buy here, pay here, and lease here, pay here space. So this is something to be mindful of. But I would say this to me, this little limited data pool to me suggests the sky's not falling. We worked our way through some stuff. Most of these dealer charts are pretty flat to stable. And so there's some of them that show some positive uptick. So, but I think we need to move past opinions and just make sure that we lean on data to decide what's really happening.
Yeah. Hey, everybody, it is Friday. Hope you guys have a great rest of your day. Thanks so much for joining us today. We know that you've got a lot of options to spend your time. So we're really grateful and keep coming with ideas for things that you'd like to have us talk about. Just reach out to Jim at whitehatway.com. And if you need any help, that's another great way of reaching to us as well. So have a great day. Thanks again. Enjoy your Friday.